Thank you for joining us today. My name is Larissa Pitol. I'm a principal of ClearBridge Financial. And today we will talk about family gifting strategy and a tax sunset that's coming up. We have a great speaker today from Vanguard, Julia, tell me how I say your last name.
Fuentes.
Fuentes. And she is the financial planning and coaching specialist and strategist for Vanguard, with vast majority of topics we've discussed previously, knowledge on all of them. So today I'm sure we will gain a lot of understanding and also see what's coming in the next few years based on potential new legislation that if it doesn't pass, what we should expect, and if it does pass, what would be our strategy. So we'll cover gifting strategies, we'll talk about what to look for, and also if sunset does happen in a couple of years, what our expectations and what our strategies would be for that as well. So without further ado, Julie, the floor is yours.
Thank you so much. And thanks for joining us today. So today we're going to talk about the tax sunset. So you might have read stuff in the news. This has been going on for quite a while. So back in 2017, under President Donald Trump, they passed the Tax Cuts and Jobs Act. And this permanently lowered corporate taxes. But when it comes to personal taxes, they were not able to get that through as a permanent tax break. It's only temporary. So they call this the tax sunset. So effective January 1st of 2026, a couple things are going to change, and we're going to talk about some of them that could have implications for you personally. Is our income tax rates could be going up. We have some of the deductions, the ways that the taxes work today, they're going to sunset back to the way they were prior to 2017. And there's something we're going to talk about today about lifetime estate and gift tax exemptions that are reverting back to the way they were before the Tax Cuts and Jobs Act. So first, we are going to talk about the individual income tax rates. And we're going to get something as follow-up after the call. So you're going to have all of this in a brochure package. So you're going to be able to see these tax brackets. But as of right now, you can see on the left-hand side of the screen here for 2023, we have the single, the married filing jointly brackets on here showing what your current tax bracket will be. And you can see as you go up in income, your tax bracket will gradually increase. Will come 2026, if no additional legislation is passed, at sunset, you can see what your taxes may increase to. So what's interesting here is in the lowest tax bracket, there wasn't any difference. And in that 35% tax bracket, there wasn't a difference there. But you can see if you are on the high end or somewhere in the middle where a lot of us may fall, you're going to see yourselves come 2026 if you're in that middle tax bracket paying 24 right now, you could find yourself with a 4% additional federal income tax. So the reason why I'm pointing this out to you is if you're someone that's been mulling over doing a Roth conversion, you have a lot of traditional IRA assets, you may want to consider a Roth conversion, because what a Roth conversion does for you is in the future, you won't have to take a required minimum distribution. You can leave a tax-free inheritance to your children. You have a pool of money that you can take the money out without having to pay taxes on it. So there are some benefits to Roth. And just so you know, legislation is always happening. We don't know who the president is going to be. There's going to be elections coming. So it is likely that depending on who comes in, who our new president could be, maybe we have the same president, we don't know. They might not allow this to sunset, and they may say, you know what, we're going to extend this again. So this is just planning off of what we know today. If no new legislation is passed, come 2026, this is what your tax situation is going to look like. So you can lock in the tax rates as they are today, doing a Roth conversion. But the downside to the Roth conversion is a lot of us that aren't 59 and a half, we have to have money set aside in a taxable account somewhere else to pay the conversion taxes. Otherwise, you can get a penalty. So if you decide to do that, you might have to, eat up some of your savings to pay the taxes. But over the long term, a lot of times this makes sense. So it's really important to work with your financial advisor to see what you should do for your personal situation and manage between these tax brackets. Because some of us aren't going to do a Roth conversion all in one year. We're going to do small lumps to stay within tax brackets and maximize our situation. So 2026, that's what we all have our eyes on right now. So when it comes to estate taxes and gifting, so the federal estate tax right now is 40%. It's a 40% tax that is taxed on assets above an exemption amount, which is pretty high. So your exemption amount right now is almost 26 million. So if you have an estate above that, the 26 million for married couples, so for a single person, it's around 13 million. If you have an estate above that, there's a 40% tax on those assets above that. So this is something that higher net worth families really have to keep an eye on. When it comes to gift taxes, so federal estate taxes and federal gift taxes are somewhat linked because they allow you to gift during your life or at death. So that's all in one. They look at it as the same pool. So let's say you have a large estate and you want to see your children enjoy your assets. I want my child to be able to, I want to buy a house for my child. You are allowed to gift them the assets during your lifetime and not pay a gift tax. So I think there's a lot of confusion around that people are like, oh, I can't give, $500,000 to my child to buy a house because then I'm going to have to pay a 40% tax. So that's not true. You can gift up to your lifetime exclusion amounts, your exemption, during life or at your death, which brings us to that lifetime estate and gift tax exemption. That's that total amount exempt from the federal estate and gift taxes, which you can see almost 13 million per individual in 2023. Another thing I want to mention as it comes to these exemption amounts, the next thing we're going to talk about is this sunset, because these limits are going to be changing if no new legislation is passed. There's something called the deceased spousal unused exclusion amount. So let's say your spouse passes away. If your spouse passes away, you can actually file a return that locks in these exemption amounts for your deceased spouse. So you say, oh, my spouse died this year. I'm going to lock in their $13 million so I can use that later on. Now, generation skipping tax, this is all kind of linked to these others too. So they understand, the government realizes that people are going to try to get around these rules. So they say, we don't really want you to skip a generation and give your money to your grandchildren, because that could avoid the, federal estate tax and having to pay that twice. So they're on to all of us. So they do have a generation skipping tax that they will impose, but you can gift to your grandchildren up to that lifetime exemption amount, but they don't let you do more. They do take note on who you're gifting to, so they can ensure that they can get their tax with each generation. So this is something really important about this tax sunset. So these lifetime exemptions that we're talking about, this total amount of your estate that can avoid estate taxes that you can gift at your death or during your life, they're scheduled to sunset in 2026, and it's going to be cut in half. So you can see back in 2004, it was $2 million. So President Trump, this was a big thing for him. He hated this like high estate taxes. So when he came in and he passed this, act, we were at under 6 million. So you can see $5,490,000 in 2017. He passed the legislation, which temporarily doubled this lifetime exemption. So you can see in 2018, the exemption was doubled. And what you're looking at is the per person amount. So if you're married, you can take this times 2. Well, of course, these are inflation adjusted. So you can see how it's gone up with inflation, and we've had some pretty high inflation. So come 2026, when everything sunsets, if no new legislation is passed to extend this longer, you can see that that's going to be cut in half. So this is an estimate because we don't know what inflation is going to be up till 2026, but it will be inflation adjusted, but it's reverting back to the 2017 numbers adjusted for inflation. So we're assuming it's going to be somewhere around 6.5 million per person. So some people already made plans to, hey, gift and get this money out of their estate to lock in this amount just in case it isn't extended and it is cut. Who knows, maybe we go back to 2 million. They can do whatever they want, but I'm thinking we're not going back to 2 million. It's probably going to be more around the 6 million. But if you already got a lot out of your estate, just keep in mind there was extraordinary inflation and we had a huge inflation adjustment that you have almost an extra 2 million you can get out of your estate looking at 2022 going into 2023. One thing to think about, because you might be looking at these numbers depending on your situation, and you say, you know what, I don't have those kind of assets. I don't think I really need to think about this. But I want you to think about the growth on your assets. So let's say you have $3 million. This chart that we're looking at here is showing the number of years it would take to double this investment at different rates of return. So this is like standard, typical time value of money. So a lot of us that have just a balanced portfolio, we can expect 5-6% on a balanced conservative portfolio. Maybe you are really conservative. 3% is right here, but you can see, let's just say you get a 5% average annualized return. That 3 million will be $6 million in 14 years. So think about your longevity, looking out into the future and where you're going to be. So even for people with $3 million, we're going to talk next about some evergreen gifting strategies. If you're between that, 6 to 13 million as a single person, 13 to 26 million as a married couple, this is a good time to meet with your advisor and plan a little bit. We're right in that middle zone. People that have over these assets, you have over 13 million as a single person, over 26 million as a married couple, you should probably think about acting now, talking to your advisor about what you should do to potentially move some money out of your estate and start on a gifting strategy. So you can lock in some of these lifetime these exclusions while they're at the elevated levels. So we're going to talk about a couple evergreen gifting strategies. So we talked about your lifetime exemption amounts. Hey, you can gift this $13 million per person whenever you want. You do have to file some returns just because there is a tracking system. There's a form 709 that we have to fill out if we do give $500,000 to our kids, because they track it on the back end, what you gifted during life and then at death. But you are allowed to do outside of that $17,000 per person to whoever you want to. And if you're a married couple, you can, you each get that. So it can be $34,000 that you can give to each recipient. It can be your friends, your family, your grandchildren. Anyone can do this, and this does get adjusted for inflation. It might be $18,000 next year. We don't know, but this is always something you can do without having to fill out any tax forms. You don't have to record anything. You can give the money to whoever you want without having to worry about any kind of gift taxes. So a lot of people have some strategies, work with their advisor on, hey, I want to do this. I want to give money to my grandchildren. How can I do this? You can take assets that you have and you can gift them without selling them and having a tax event. You can gift them and pass that along. But just keep in mind that when you die, there's something called a stepped up basis, that when you die and the assets pass to your heirs, they get the stepped up basis of what's the asset worth today. If you go and gift it during your life and you gift it in kind, which makes sense in a lot of situations, when I say gift in kind, you're basically taking your asset, giving it to whoever you're giving it to, and you don't have to worry about a tax consequence, but they take on your basis. What did you buy it at? There's a gain on there. If they sell it, they're going to be responsible for the taxes on that. So just something to keep in mind, a great reason to work with your financial advisor to see what works best for your tax situation and the beneficiaries of your gifts, their tax situation. So another option for these evergreen gifting strategies that anyone can do, you are allowed to, they call it front loading a 529. So you can front load 5 years of annual gifts for the beneficiary. So if you're someone that's very passionate about college, education, because 529s can be used outside of college, they can be used for other educational expenses. That is $85,000 at once that you can do per beneficiary, doubling for married couples. You can give that to all of your grandchildren. The one thing to keep in mind, if you die within the 5-year period, they do kind of claw that back and they say, okay, and you also can't go and make another $17,000 gift to that person over the 5-year period. It's basically taking that $17,000 gift, doing it all at once. You don't have to file any tax forms, but you do have to take off from giving that specific person. Let's say it's your grandchild. You can't, in addition, give them $17,000 for the next 5 years. But this is really great because the 529s, they can grow tax-free. There were some changes to the FAFSA. So if you have a grandchild that may be able to qualify for financial aid, they know they've changed the formula that they no longer count the grandparent-owned 529 for needs-based financial aid. some of us, the person we're gifting to, they're not going to qualify for it anyway, but just something to think about. There's one more thing with 529s that I'm a little excited about, is just at the end of last year, so it just went into effect, that they passed legislation called Secure 2.0. This actually starts in 2024. So they announced it, passed the legislation, but we can't do it until next year. For people that have overfunded 529s, let's say you had too much in there, you did this, you front loaded, gave $85,000 to a grandchild, they went to a very inexpensive school, and now you have money remaining in there. They are allowing you to roll over these overfunded 529s to a Roth IRA. The catch is it's a $35,000 maximum that you can roll over, but it's still something. And they also don't let you roll it over all at once. You have to roll it over according to whatever the annual IRA limit is for the year. And you can do it, you can't do it all at once. You can change the beneficiary to yourself for the 529 and fund your own Roth IRA, but it's just an option. There's a lot of fine print and rules, as there always is. So work with your financial advisor if that's something you're interested in, if you have an overfunded 529. The other thing that might be a little bit less common is for gifting, you can always pay for qualified tuition and medical expenses directly to an institution. So if you want to go and pay for your grandchildren's tuition directly to the school, you can just pay for it outright, and you don't have to worry about any kind of gift taxes. And then the last one to think about is maximizing gifts to qualified charities. This is one more thing that is sunsetting, and this isn't a huge one that people complain about, but cash contributions that you make to charities. The limit right now is at 60% of your adjusted gross income. That's going down to 50% of what you can actually deduct on your taxes. So there's something called a qualified charitable distribution. If you are age 70 and a half, you're going to want to talk to your financial advisor. If you're charitably inclined, you can make donations of $100,000. It will go directly towards your RMD. I know we changed the RMD ages, but they still kept this at 70 and a half. But basically, you can give that money to the charity. It is going to come right out of your account, not show on your tax return. It's a very tax efficient way to give to charities. So just something to consider if you're trying to work with your tax return, keep your taxes low. There's lots of ways you can do donor advised funds. You can gift some securities in kind to charities. Of course, cash is always easier, but you do have options. And there's a lot of charitable trusts. So this is something you really want to work with your advisor on a gifting strategy to figure out the best way to do that. So what we're going to do, you're going to get an email after this call that we have all of this in a brochure. So it's all documented. So you're going to have, what's changing, some, the tax brackets. You're going to see the lifetime exemption amounts, and also these evergreen gifting strategies. We do have them all documented for you here, so you have a resource to reference back to. So with that said, something I would recommend doing is, if you haven't already, if you're somebody that is thinking, hey, I really want to start getting my life organized, I really want to figure this all out, do things right, having a family meeting is a really great thing to bring your heirs into the fold, because what we tend to see is you can have the best estate plan ever, but if there's not proper communication within your family after you pass away, things break down. So communication, having everybody on the same page for your wishes, your goals, your desires is a really great thing to do. So think about having a family meeting, talking to your heirs, because it'll make things flow a lot more smoothly in the future. So I can open it up to any questions that anybody might have.